This concept, in my opinion, is one of the most important ICT concepts that you need to master, and it will help you with finding daily bias, getting a higher reward to risk trades, getting a higher win rate, knowing where to put your take profit, getting sniper entries, and much, much more just based on this concept. Want to know how to look at the market in the right way? Let me show you. The first thing that we got to cover on this lecture is why price move. And I mentioned this a lot of the times before, and I always repeat it. Why? Because as much as it's so basic, but it's a real thing, right? If you go to the chart, you're going to see that price will only do one of those two things. That's always the reality. However it takes, but it's going to be only one of those two. Either rebalancing fair value gaps, so simply we have a fair value gap, price will come back to it, or it's going to seek liquidity. So basically it's going to go and take highs or lows. One of those things is going to happen on the market. That's it. And some people say, price coming into equilibrium, and that's actually one of those, right? Price coming into equilibrium is going to either seek liquidity or rebalancing a fair value gap. So those are the only two things that price is going to do. And I will show you on any chart, on any time frame. If you look at the chart and if you meditate on the chart, you're going to see that only two things that happen. Now, looking at this daily chart, right? This is Euro USD, the daily chart. What we can see here, so starting from any high or low, any dealing range. Now, even if we take a random high or low, you're going to see that price will always do the same. Now, this is the current price action on Euro USD. If we start from here all the way to the left, what we see is we had this fair value gap. Price simply filled this fair value gap, took this low, taking this high, right? Coming lower. We created a fair value gap, but we took this low. Now, as we're coming lower, what happened is we took this high, we filled this fair value gap, right? We came back to this, we took this high, we came to this fair value gap all the way right here, right? But we kept going lower, we created another fair value gap, and that's where price respected. So simply what happened here is respecting a fair value gap, taking a low. Respecting a fair value gap, taking a low. Now, coming lower, what happened also is taking a low and respecting a fair value gap, or at least filling a fair value gap. Going up from here, another fair value gap being filled, going up, taking a high. There was a fair value gap here that is also filled. As we're going up, we took this high. We're coming lower, we took this low. We took this high, we're coming up. And what happened here is filling of a fair value gap and taking a high. So you see, we respect this fair value gap, we took a high. Now again, the same thing. We took this high, we came into a fair value gap, we took this high, and it's always the same thing. And even this fair value gap, we came back to it in a while. We took this high again, and then we're coming lower. We also took this high. So even after some time, it's going to be the same cycle. Now what happened here is also filling a fair value gap, taking a low. Filling a fair value gap, taking a low. That's the move that we're going to learn about in today's lecture. But as you're seeing here, price only does two things, right? Filling a fair value gap, taking a high. And we're going to discuss the external and internal both moves. And you're going to know that as price is doing two things, it's also moving in two directions. And we're going to discuss this on the next slides. And based on this, it's simply price filling a fair value gap, taking a high. Filling a fair value gap here, taking a high. Filling a fair value gap and taking a high. That's the cycle of the market. Our sponsor, Blue Guardian, is the only prep firm that gives you a tool to protect yourself from hitting your max daily lows and prevent you from over trading. And it is very simple to use. They also have a new unlimited time evaluation with low profit targets and no trading days requirement, so you can get funded in the same day. Blue Guardian is a prep firm that I trust. Use the link in the description below and use the code MOLHAM to get 10% off your next Blue Guardian evaluation. Now into external and internal liquidity. This is the core concept of today's lecture. We gotta know what external is, what internal is, and we already know what a liquidity is. But in any dealing range, we have a dealing range that is, a low that took a liquidity and a high that took liquidity. We have this external high and we have this external low. So on any range, when we have a high and a low, then that's our external range. That's our external liquidity and external liquidity. Anything inside of this range, so anything in between this high and this low, that's all internal. Now you ask yourself this question, what do we have inside of the range? What do we have inside of the range? On the same time frame, we have fair value gaps. So in the same time frame, as I said, we have fair value gaps, but on the lower time frame, we have other highs and lows. We have another liquidity level also, or other liquidity levels inside of the range. And what are you going to know? Why are we ignoring those levels of liquidity and only focusing on a fair value gap as our internal liquidity? You're going to know this on the next slide. So make sure to stay tuned. So basically, as a general rule, we have this high, this low, that's our external range. Anything in between is internal. Highs and lows are external. Fair value gaps are internal. Now, you also need to know, why did we focus on fair value gaps as our internal structure or internal liquidity, and we forget about all of the small, or the lower time frame highs and lows? Only because of one thing, that fair value gap is nothing but a liquidity. What does that mean? This is a 4-hour chart. If we look at this 3-candle pattern, which it created this fair value gap here, that's our fair value gap. This is in the 4-hour. Now, if we just look at the 15-minute or any lower time frame, that we can see the structure or the fractal of this fair value gap, what happened inside. Simply on the 15-minute, this low, or first candle, second candle, third candle. So in a bullish scenario, the low of the third candle of the fair value gap is going to be nothing but a liquidity level. So that's a liquidity level actually. That's why fair value gap works, because they're nothing but a liquidity sweep here and then going up. That's all. Now we're looking at the 15-minute to the right. What we see is this is where the fair value gap was created. But what we see is, and this is price actually trading into the fair value gap on the 15 minutes. But as price came up, created this fair value gap on the 4-hour, because we were not able to trade inside of this range on the 4-hour. But what happened is price going up, coming lower. We did not trade into the zone. That's the low, the same as this one. That's the low of the third candle in a fair value gap. That's actually the low. So it's literally nothing but a liquidity level on a lower time frame. So price will sweep this liquidity level maybe into an order block and then started coming up. That's all what a fair value gap is. That's why fair value gap is working, and that's why I say liquidity is everything, much more important than fair value gaps. Now, at this point, we know that price either seek liquidity or fill an imbalance or rebalance the fair value gap. But how price move? There are also two ways that price moves, and it happens over and over and again in different time frames. Any time frame, you can actually see this. Now, we got to understand first, and we already discussed this before, and I give the general rule of external is highs and lows of a dealing range, internal are fair value gaps. We got to know that price will only move in two different ways: external to internal or internal to external. What does that mean? As we're going up, we were actually going up here. We took a level of liquidity, let's say to the left, and we're starting to come lower. Now, in the blue, this is actually a move of external to internal. So we see how price was coming from this external liquidity, coming lower to where? To the internal. So now we know that when we take a liquidity level, then we usually retrace into a fair value gap. So the right way, or the right spot to place your take profit when actually taking a high is placing, or taking profit at the fair value gap. Now, on the other hand, and this is on red, we're coming from this fair value gap and getting respected from the fair value gap and going up. Now, if we get an entry here, what do we target in this case? We're not going to be targeting a fair value gap here. If you want to maximize the profit and capitalize on this concept, then you target the external liquidity level, because we're going from internal to external on this move. So it's always like this: external to internal, internal to external, and then again, you see, internal to external, and it happened over and over. That's why this uptrend, for example, is nothing but a move of internal to external, internal to external. Breaking a high is external. Retracement into the range again is an internal move. From that range, or from that retracement into the range, going up and breaking a high, that's a move of internal to external. And it happens, as I said, over and over. Now, you don't need to just take all your profit here, because sometimes we anticipate a breakout structure, which is price displacing above a high. So make sure you know what you're doing based on this. You know how to actually differentiate between a liquidity sweep and a breakout structure. But simply, that's how price moves. Internal to external, external to internal. Fair value gap is an internal, and highs and lows in the dealing range are external liquidity. That's the move of the market. We're going to learn how to find daily bias. We're going to learn how to find a high reward to risk trades only using this concept. Now, if you want to find your daily bias, so a lot of people struggle with daily bias. Daily bias doesn't mean only focusing on the daily time frame. Daily bias is a concept just telling you if you are with the trend or against the trend. So be sure that you can actually use it on any time frame, not just the daily. But for this time, we're looking at the daily time frame, and I just want you to see how we're able to actually determine and find our daily bias on the easiest way. Now we know that price moves external to internal, internal to external. That's the move of the market. Now what we see here is we can see as price coming lower, we are looking for a retracement, right? Now in this dealing range from this high to this low. Now why taking this fair value gap, the extreme one, and not this one? Because this is literally at the low of the range. You don't go long from here. That's why I'll be considering my dealing range from here to here. I'm not gonna only look for this one and this high and this low. It's gonna be against the logic. And why? When I have a big range that is created and then I have another small one, usually the small one will be nothing but an adjustment. Okay, so that's why I was looking for this fair value gap. As prices coming up into the fair value gap, getting a respect on the lower time frame, and there is a change in state delivery on the lower time frame, I would know that most of the time, if this fair value gap is being respected and there is a lower time frame market such a shift, I would know that I'm now going from internal to external. What is the external range, or the external liquidity? It's basically this one. So now from here, from the internal, I would be only looking for shorts all the way to where? To the external liquidity. So my bias would be going short for all those days. All those days, I'll be nothing but going lower. Now, as price coming lower, we actually broke below the low, right? And the price decided to actually, go lower. And now we are retracing back into what? The internal liquidity. After, there is changes to delivery right here. You can see we have the one here. We're starting to come up. Now, if you took a turtle soup entry from here, then I'm not gonna be actually targeting this high or this high. I'll be only targeting the internal liquidity, and this is also an overlapping period area. So we have a low inside of a fair value gap. That's a good place to actually enter a trade from. You see, we got respected here, changes to delivery. Now, where do I go? From this point all the way to this fair value gap, my bias was going up. At this point, we're coming lower, all the way to where? To the external. And you see, it repeats over and over. Price coming into the internal, coming back into the external. My bias was going up here, my bias is going lower here. And as I said, it repeats over and over. It's always the same. It's always the same. So this is external, and fair value gap is internal. You see, internal, coming to external. Internal, coming to external. Internal, coming to external. It's always the same cycle over and over. So you could actually find your daily bias, find your direction to be with the trend using this method of the external to internal move, or the opposite, internal to external. How to get a higher win rate and a higher reward to risk using the concept of external and internal liquidity. Simply, instead of targeting just any higher low or targeting any internal liquidity, now we know that when we're coming into internal, we're going to be targeting external, and we're coming into internal. We have a model here. We're not going to be targeting this low and just be satisfied with 2R. What we can do is not even come into this fair value gap. We'll be looking for this low. Why? Because now we're having an internal move to the external, targeting this low, ultimately this low. That's why, as of now, what do you expect? Simply price to, if we get a lower time frame confirmation here, we're going to look for this low to be taken and not just this fair value gap to be respected, or this one, or just this low to be taken. No, it's going to be ultimately this low. And this is what we actually see. Breaker structure, or basically external taken, price coming back into internal. And on the 5 minutes, as prices come into this fair value gap, what we saw is simply a market structure shift, price coming into the point of interest, leaving a fair value gap where we could enter from it. Now, this is the fair value gap on the higher time frame. This is where we enter. And then after that, targeting not this fair value gap, not this one, but ultimately this low and maybe more. And you see, that's where actually price went. Now, understanding this concept, the external to internal and internal to external, will give you confidence to actually target this low. Now, based on the same concept, external to internal, internal to external. Another example, what we're having is, we had internal respected, go into external. Now we have external and another external. Now we're going to go to internal. And we have actually this fair value gap. There is another one below, but most likely this would be left. If you understand the breakaway gap concept, then we have this fair value gap. Now what we're expecting is price coming into this internal and go into what? External. That's why we need to look for a lower time frame confirmation right here. And that's what we're going to do. That's actually our fair value gap on the 1 hour, but now we are on the 5 minutes. And that's our high, the external liquidity on the 1 hour. So now what we see is we're having this external to internal and now internal to external. Now looking at this fair value gap and looking for a lower time frame confirmation, you could be taking this first fair value gap as your entry, or this changes the delivery, any of those entries. Stop loss below the low, but give it some room for price to breathe, at least cover the low of the first candle of the fair value gap, and then entering from there, not targeting this high, not targeting this high, not targeting any fair value gap in here, but ultimately this, and sometime price will be actually displacing above. And this one, it could give you the double if you were able to spot this breaker structure here instead of just considering at a liquidity sweep. So if you were able to anticipate this breaker structure, you could actually be able to get more reward to risk out of this trade. That's how you can get, as I said, higher win rate, because you would know where to actually look for your trades, what point of interest, and then how to get a higher reward to risk by knowing what to target, internal or external, based on this concept. That's all for today's video. Hopefully you guys like it. Make sure to join the Discord. I do a lot of seminars there, live trading, and a lot of education content, as well as leave a comment, hit the like button, and subscribe to the channel. I really need your support, guys, to push more content to you, because that takes a lot of my time, but I do it because sometimes I get a lot of good comments. That's why I'm doing my best in order to push and deliver the highest quality content. This is Monham, and I'll see you in the next video.